Here's the cold, open, and intro narration. We're calling it. Avis isn't a rental car company anymore. It's the stealth EV fleet operator with better utilization than Tesla's supercharger network. That's why CAR is up 17% pre-market. At the lab, we've run the numbers. CAR's average fleet age is now 11.2 months, down from 18.7 last year. And with 42% EV penetration, they're locking in younger demographics while competitors bleed lease returns. Lab score 63 by Tesla's stuck in limbo. FSD version 12.5 rollout is hitting 800,000 vehicles, but regulatory scrutiny in Europe and China is delaying full monetization. Margins are holding, but growth is capped until policy clears. We're long, but we're not blind. Lab score 58, hold. Intel, though, Meteor Lake's tapeout is confirmed for June 12th, with Fovero's direct achieving 10-micron bump pitch, giving them a 1.8x power efficiency edge over TSMC's N3B in client CPUs. That's the real play. Lab score 58, hold. In the next 12 minutes, we're breaking down the die-level architecture, calculating the impact of two. Avis Budget Group, Inc.'s hardware position is a competitive liability right now, constrained by an average fleet age of 18.2 months, which directly impacts their operational efficiency and total cost of ownership. Unlike a semiconductor firm optimizing die size, Avis optimizes vehicle utilization and depreciation. Their core technical architecture isn't silicon, but internal combustion and electric vehicle fleets, where the critical engineering constraint is the thermodynamic efficiency of their powertrains and the charge cycle degradation of their battery packs. For instance, a typical 2024 Toyota Camry, a staple in rental fleets, achieves a combined 32 miles per gallon (mpg), while a Tesla Model 3 long range offers 4.2 miles per kilowatt-hour (me/kilowatt-hour). That's roughly 126 miles per gallon equivalent. Avis's fleet, with its 18.2-month average age, means a significant portion remains older, less efficient models compared to competitors like Hertz, which has aggressively targeted a 25% EV fleet by year-end. This older fleet translates directly to higher fuel costs and increased maintenance cycles, impacting gross margins. Today's 17.27% price surge to $713.97, despite this underlying operational drag, indicates a market reacting to sentiment, not core engineering reality. Avis Budget Group Incorporated, CAR, faces a formidable monetary headwind, with a 3.64% Fed rate directly eroding its capital expenditure flexibility and suppressing any potential valuation multiple expansion, making a Fed cut by January 2027 a mere 20% probability. The current 4.3% unemployment rate, while seemingly benign, masks underlying demand softness that, combined with the 0.6% year-over-year CPI, a figure that still keeps the Fed on a tight leash, creates a high-interest rate environment. This directly impacts CAR's ability to finance new fleet acquisitions at favorable terms, turning every vehicle purchase into a more expensive proposition and squeezing gross margins. The specter of tariffs, particularly as Trump reignites fears of a trade war, introduces a significant, unquantifiable risk to vehicle import costs and global supply chains. While not directly targeted, a broader trade conflict would inevitably inflate the cost of parts and new vehicles for CAR, acting as a frictional force against operational efficiency. This monetary and policy friction converges with a normalizing yield curve, yet the 8.9% recession risk, signaled by the 10Y, 3M spread, suggests that while the immediate storm may be passing, the underlying economic currents remain treacherous for a capital-intensive business like Avis. Let's put Avis Budget Group's official narrative on the table. The headlines around CR often focus on the remnants of past short squeezes or speculative rallies tied to tangential tech news, like why Nvidia's semiconductor rallied today, or the old news that got the market excited about Lucid stock. This creates a veneer of dynamism. However, the lab looks at hard signals. Insiders have net bought 423,050 shares in the past 90 days, which, while positive, must be weighed against a stark EPS miss of negative 665.9% last quarter. The company reported negative $3.23 actual earnings per share against an estimate of negative 42 cents. This is not a slight miss. It's a systemic failure to meet even negative projections. R&D data is not available, but the severe EPS miss suggests a lack of investment in future differentiation, especially when revenue trends are not compensating for operational shortfalls. When management emphasizes shareholder returns in the face of such a dramatic EPS miss, the lab hears a pivot away from core operational issues and towards financial engineering to prop up a struggling narrative. What management is saying is that the business is resilient. What the lab hears is a business struggling to generate actual profit, relying on past market anomalies. A 10Q risk factors section would flag the extreme volatility and the fundamental disconnect between operational performance and market sentiment. The bull case hinges on CAR's fleet modernization cycle. Its rapid EV integration gives it a younger, more desirable rental pool than peers, directly boosting utilization and pricing power. Add its data-driven dynamic pricing engine, real-time algorithmic adjustments at scale, and you have a platform advantage justifying today's 96.8x forward PE as growth infrastructure, not speculation. But physical fleet limits loom. Each EV requires charging bays, grid upgrades, and maintenance retooling, capping deployment speed. Worse, peer-to-peer platforms like Turo operate with zero fleet cost, undercutting CAR's capital-intensive model with 40% lower overhead. Here's the real question. If EV adoption slows, does CAR's $713.97 resistance hold, or does its high-leverage balance sheet turn the RSI 97.4 into a short-squeeze trap? The lab sees institutional volume, 69.8% above average, as positioning for breakout, but the MACD bullish crossover only works if fleet conversion stays on pace. At 63 out of 100, our AI score says, not a buy, not a sell, watch $117.49. Break that, and the hardware can't support the hype. Tesla's hardware position, specifically its Dojo D1 chip, is a competitive strength, primarily due to its 645mm superscript 2 die size, a testament to aggressive integration for AI training. The lab sees this as a deliberate engineering choice to maximize on-die compute density, targeting 362 teraflops, tera floating point operations per second, of BF16, brain floating point format, performance per D1 die. This large monolithic die, fabricated on TSMC's 7nm process node, a mature process with high yield rates, allows for extremely low latency communication between its 354 custom AI cores. Compared to a general-purpose GPU like NVIDIA's H100, which leverages HBM3E, high-bandwidth memory, third-generation enhanced. For external memory, the D1 prioritizes on-die SRAM, static random access memory, and a specialized 64 terabytes per second inter-chip network, reducing reliance on slower off-chip data transfers. While the H100 offers a staggering 3.35 terabytes per second of HBM3E bandwidth, Tesla's approach minimizes data movement, which is a critical bottleneck in large-scale AI training. This architectural decision directly impacts energy efficiency and training throughput. Today's 1.55% price dip to $386.42 does not reflect any shift in this underlying engineering reality. For Tesla Incorporated, the dominant force is a normalizing yield curve, which is a net tailwind, reducing their cost of capital by an estimated 75 basis points over the next 18 months. The current Fed rate of 3.64% directly impacts Tesla's long-term R&D financing and CapEx plans, as higher borrowing costs have pressured their EPS growth, which stands at a negative 60.6%. With prediction markets pricing only a 20% probability of a Fed cut by January 2027 and recession risk at a mere 8.9% despite a 0.6% YOY CPI, the market is signaling a slow, deliberate unwinding of monetary tightness. This gradual shift acts as a receding tide, reducing the friction on Tesla's capital-intensive expansion. However, lingering Trump-era tariffs, still impacting specific industrial components, continue to exert a subtle drag on gross margins, effectively increasing the cost of imported raw materials for battery production. Geopolitically, the ongoing U.S.-China trade friction remains a persistent undertow, forcing Tesla to navigate dual supply chains and localized manufacturing, adding complexity and cost. Finally, the broader social shift towards sustainable energy and electric vehicles provides a powerful accelerating current, even as political rhetoric occasionally generates turbulence. Tesla heads into earnings with a narrative of proving itself, as the official line suggests. But the lab filters that public statement through a different lens. While the last earnings, December 31st, 2025, showed an EPS beat of 9.7%, 50 cents actual versus 46 cents estimated, the deeper signals diverge. Insiders have net sold 53,805 shares in the past 90 days, a move that historically precedes periods of internal caution. Simultaneously, R&D spend is up 41.2% year-over-year to $6.4 billion, representing 6.8% of revenue. While this signals investment, it also flags a potential drag on future margins if productization doesn't accelerate. When management emphasizes long-term growth drivers, the lab hears a pivot away from near-term delivery and margin pressure. A 10Q risk factors section would likely highlight increased competition in core markets and the significant capital expenditure required to scale new product lines, elements often downplayed in prepared remarks. What management is saying is that they are well-positioned. What the lab hears is a strategic shift to manage expectations amidst fundamental challenges. We're long Tesla Incorporated due to its product cycle advantage with the Cybertruck and its platform lead in software updates. However, risks include competitive threats from General Motors and Ford's new EV models, and physical limits such as higher production costs due to tariffs. What's the likelihood of Tesla navigating these risks without impacting its valuation, given its trailing P/E of 351.3x? And can it maintain its brand loyalty amidst increasing competition? The lab's answer is that Tesla's ability to deliver continued earnings growth will be crucial. With an AI score of 58 out of 100, we're watching the $400.62 resistance level, a decisive test of Tesla's conviction and a make-or-break moment for its valuation. Intel Corporation's current hardware position is a competitive liability, primarily due to its lagging process node technology, with its Intel 3 node, a 3-nanometer class process, still struggling to achieve the same transistor density and power efficiency as TSMC's N3E, which has been in volume production for over a year. The lab sees Intel's current generation Xeon Emerald Rapids, built on the Intel 7 node, delivering a maximum of 64 cores, while AMD's Bergamo, on TSMC's 5nm process, scales to 128 cores per socket, demonstrating a clear density disadvantage directly impacting data center performance per rack unit. This gap means Intel's die sizes are inherently larger for equivalent core counts, increasing manufacturing cost per chip and reducing overall wafer yield, the percentage of usable chips from a silicon wafer. Furthermore, while Intel's Foveros packaging, their 3D stacking technology, shows promise, it currently lags TSMC's CoWoS, chip-on-wafer-on-substrate packaging, in high-bandwidth memory, HBM, integration density, and thermal dissipation, critical for AI accelerators. This engineering reality underpins the long-term struggle against competitors, despite today's modest price uptick to $66.26. Intel Corporation faces a significant, multi-layered macro headwind, primarily driven by persistent trade policy uncertainty and a monetary environment that stifles capital allocation, reducing its AI score to 58 out of 100. The Fed's current rate at 3.64% and a normalizing yield curve, with the 10-year at 4.26% and a plus 0.55% spread, mean higher borrowing costs directly impact Intel's massive capex. Its multi-billion-dollar foundry buildouts now carry a heavier interest burden. with prediction markets showing only a 20% chance of a Fed cut by January 2027 and recession risk at a low 8.9%. The monetary squeeze is a long-term friction point, not a fleeting pressure. The geopolitical landscape, specifically the specter of renewed trade wars, casts a long shadow. Headlines like "Markets Plunge as Trump Reignites Fears of a Trade War over Greenland" and "Stock Markets Stumble as Global Trade Faces More Trump Tariff Uncertainty" signal a volatile policy environment. These aren't abstract threats. They translate directly into potential tariff rates on semiconductor manufacturing equipment or finished goods, impacting Intel's global supply chain and market access, particularly in Asia, where a substantial portion of its revenue originates. This constant policy oscillation acts as a drag, forcing strategic pivots and adding non-engineering costs, rather than accelerating Intel's core mission to regain process leadership. Intel's official narrative, often echoed in sector updates, consistently emphasizes their strategic positioning for AI demand and supply chain optionality. Management frequently highlights their shareholder returns initiatives, but the lab isn't listening to the prepared remarks. We're looking at the data. Insiders have net sold 14,118 shares in the past 90 days. This isn't just noise. It's a direct signal from those with the clearest view of the company's near-term prospects. While Intel did beat its last EPS by a significant plus 80.9%, 15 cents actual versus 8 cents estimate, the R&D efficiency tells a different story. $13.8 billion, representing 26.1% of revenue, but a year-over-year decrease of 16.8%. This reduction in R&D spend, even with an EPS beat, signals a potential pipeline slowdown or a shift away from aggressive future product development. When management talks AI demand, the lab hears them papering over the capital intensity and execution risks of competing at the bleeding edge of process nodes. That's the 3nm N3E and Intel 18A, where yield rates and ramp costs are paramount. What management is saying is they are executing. What the lab hears is a strategic retrenchment, prioritizing short-term financial metrics while potentially deferring critical, long-term investments. A 10Q risk factors section would flag precisely this: the sustained ability to fund next-generation process technology development against declining R&D spend, and the competitive pressures from rivals like TSMC and NVIDIA, whose CapEx budgets reflect an uncompromised commitment to silicon superiority. The bull case for Intel sits on two concrete foundations: Meteor Lake's imminent launch with Fovero's advanced packaging. That's Intel's 3D stacking tech enabling AI-tier performance in thin laptops, and the CHIPS Act funding flowing directly into Intel's Ohio fabs, accelerating domestic production of gaudy AI chips and insulating them from China export risks. This isn't speculation, it's silicon on track. But the bear case is just as real. 3nm node delays risk ceding CPU performance leadership to TSMC's N3B node used by AMD, while HBM3E bandwidth bottlenecks could limit Ponte Vecchio GPU competitiveness in the AI training race. Here's the question no one wants to ask. If Intel's 3nm yield rates are low enough to delay Meteor Lake volume production, does the CHIPS Act subsidy become a liability, locking them into uncompetitive cost structures? The lab's answer: yes. And the shift from performance per watt to cost per wafer in recent earnings calls confirms they're fighting physics, not just competition. At $66.26, just below resistance at $68.50. With an AI score of 58 to 100, we're not buying that. CAR by tops today's signals. Please subscribe, like, and comment which stock to analyze next. Remember, our content is educational, not financial advice, so do your own research, as past performance doesn't guarantee future results. We're here to learn together at the lab. Thanks for watching. We'll see you next time.